Hello, Warriors. Good Fed Day to you. And on Fed Day, we have Fed guy Joseph Wayne with us today. So we'll see what Joseph has to say. His writings have been talking about the Fed reliquefying everything. So we'll see what he says. All I've heard is hawkish cut, hawkish cut. That's what Blake thinks is going to happen too. It's almost turned out to be a majority opinion. So we'll see if the majority's right. How you doing, AJ? And Bran, how are you? Mike, Ayaz Khan, how are you? James, Ryan, good day to you. Hugo, Richard Adam, Bill Hines, how are you? Blake, okay. Kurt, how are you? So we have a little shade of dollar weakness starting off this morning. And I'll get right to Ryan to see what he's thinking here. Ryan,
Morning,
how are
sir.
you? Hey, how are you?
Ready to rock and roll?
Okay, so do you think we could rock and roll and take out this high after the Fed? If we get a dovish cut, that should happen, don't you think?
Yeah, I think we should.
Okay.
We probably take out that high and maybe take out 117.
Oh,
I think we should at least have a look at 117. Obviously, volatility is still pretty low. So, as I said
yeah,
earlier in the week, it's going to take some big news to bring a big move. But the market is looking for this hawkish cut. If it doesn't get
right.
it, then that's going to be, we're going to see the dollar getting sold off.
Okay. Because some people are saying this might have been the low. I doesn't really look like a low to me, but did hold this black line. Um, yeah, I would. Would you fade dollar weakness or go with it?
Um, I'm not sure. It depends what's driving it. I mean, the dollar's been weak, for the last few weeks, so it's not like we haven't seen it going that way anyway.
Yeah.
The market might just be in pause mode, and whatever the Fed does, it's going to continue weakening. So yeah, I'm not that keen to fade it at the moment unless we hit some key levels in dollar pairs that are weakening.
Okay. U.S. dollar yen. Maybe we get some type of pullback from here before we challenge the highs. Maybe back to here, 56 or so, 55.60.
Yeah.
I
No
think I
shot.
would go ahead.
No, go on, mate. Go on.
No, I think I would try it here if that happened, being wrong under the low.
Yeah,
So,
I'd certainly
uh,
look at your lower levels. That you got your black line at and that 155 level.
okay.
So yeah, 154 and a half, 155. That's the sort of area I'd look to potentially fade dollar weakness if I fancied it.
Do you have any idea on USD CAD? I don't really think this is a low. That last big down day we had Friday, change the nature of it. But, we could still, can't we still, if the dollar had a run, make a move up here? I don't know about entries. You have ideas on where would you get long Canada? Let me just edit
I'd look to
myself.
get my next level is down at 137. 70, but the big level is a bit lower down, 137.35, which is the triple bottom,
Okay.
where your black line is.
Yeah, I
So
see
right
that.
around there, that's the ideal area. But
Is
138 is a bit of a level, but it's what's got me is we're bouncing to 138.66, which again is a prior high level that we couldn't get
yeah.
through in the summer, and we're just finding resistance in there. Today, yesterday, though that was just coming in shy of the high. So, yeah, that black line is where I would potentially look for a dip buy. As for selling the rally, probably not until 139s, something like that.
USD MEX still, you know, higher low. I don't think
Yeah.
it'll hold, but it's a higher low.
Yeah, that's what
Anything
you want
there.
to see. It had a, but again, the bounce got to 1830s, and I actually
Right.
missed that one for taking a bit off my long, but it fell out of bed again. But like you say, the fact it stepped up from that prior low at 1815 shows that maybe the buyers have got something about them down here. So we're probably again in wait and see mode. What happens over the Fed?
Anything on Juan here? Is it trying to bottom out?
More calls that they might look to cut their RRR, which had been touted um, in Q4 this year, Q3, Q4, but it hasn't come as of yet. Their CPI data overnight wasn't too hot, negative on the month, although it did rise on the year. PPI was lower, so inflation-wise, they're not out of the woods, and it keeps a potential rate cut on the cards. But this one is reflecting again that dollar weakness and maybe China letting it go a little bit, letting the yuan strengthen.
Okay. Besant was like that. So I mean, they're trying everything for for Nvidia to get it going. I
Yeah,
mean, so just an observation with everything they're throwing at it. One of the negatives was they couldn't sell chips, even though they're not the most recent chips. But if there had been news like this uh, before the highs up here, news like this would have sent Nvidia soaring, and all we did was get a little pop. So I'm still not impressed with Nvidia, and the Mag 7 looks like we could be putting in a right shoulder on the Mag 7. So I'm thinking that you probably sell risk if the market tries to rally, S&P's rally. So here's the daily.
But Dale,
Head and shoulders.
this is one of those events though, if everybody feels that the FOMC is just overly dovish and maybe not as divisive as they expected, this could really set off an end of year rally that you probably don't want to fade. The old adage, "Don't fade the Fed." If for some reason everybody kind of jumps in you see the dot plots kind of skew towards the risk of more rate cuts, more than two going into next year. I don't know if you're going to be able to stop this market on the top side. That's why I think you have to be careful if the reaction is bullish following today's Fed, because there's probably a reason, since everybody is already expecting a hawkish Fed right now, a hawkish, kind of between votes, between the way it's going to be divisive, and they're already expecting that it's going to be hawkish. So if for some reason we get a dovish spin on everything today, I think that sets us up for an end of year rally.
Yeah, it could. A new high in the MIGs, the CTF up here would be bearish to me too, because it would be a third drive up here, and I don't think momentum's going to confirm.
Sure,
So,
I think that would set us up for the beginning of next year, especially if we hit new highs. I bet RSIs diverged all over the place, but that would be 2-3 weeks from now. S&P's at 7,000, let's say, and Mag 7's at new all time highs. Yes, we're at highs, but relative strength would be divergent, which would set up great for shorts in the beginning of the year, right?
yeah, that could be. Yeah, definitely. And look, everything can happen. So I'd say the toughest trade right now is with what's been going on and all the great recoveries. That to me, the pain trade is the market going down. I don't think the pain trade anymore is the market going up. So just the way I see sentiment, everyone's pretty bullish. I don't even hear from any bears anymore. Heard a lot when we were here, but most everyone is saying buy any dip new highs, so they could be right. I just, look at what the mags have done compared to some of the other ones, and it's not great. And I would also warn about when you get a day like this in J.P. Morgan, and really all the banks, they really don't look that great. Here's B of A. So this would be like if the mags made a new high, something like this instead of a right shoulder. But that doesn't look good. XLF doesn't look too good. I think you need the financials to keep the thing going. And then I don't know, I think there were earnings for JP Morgan yesterday, but it really got clipped pretty hard. And I think that the market, I know they're rotating away from Mag 7 stocks, but I don't think it could do it without the financials participating. I don't know where I have it, but JP Morgan was down like, I don't know, 8% yesterday. So
Yeah,
I
I
don't
don't think
like
it
the
was.
way that
It
they,
wasn't. I don't think it was earnings. Maybe it
here,
was
here,
earnings.
here it is, some type of expenses. That doesn't look good. So, it's one of the leadership, whereas Goldman Sachs still looks okay. So maybe it's JP Morgan specific, but the XLF and B of A and even Citi look toppy to me. So we'll see. That's not a bullish chart to me. Um, and this has been a market leader. So they're picking off market leader by market leader, and yeah, they're rotating into other things. They're probably selling J.P. Morgan and buying KRE, which is the mid-sized banks, where we had issues a few years ago. So I think that's about it. Crude is trying to break down, but I still think it could hold. Um, here it is. We'll see. It's really frustrating trade. I thought we were going to have a breakout here, so that's not happening. And I'm thinking of shorting silver at about $75 today. So we'll see if it gets up there. April Fools, uh, 61.13. So that's a monster. And and there's the gold silver ratio just really a collapse. So
When's that
I
going to
don't know.
turn? When that turns, do you sell silver?
Yeah, if it but the RSI is such an extreme reading. We're down here. I wouldn't think it would be long lived, but you could get some kind of a squeeze. But I don't see anything in the RSI that tells me I want to get long with a 21 reading. So I don't know when it's going to turn. If I had to guess, I would say it would be today and only temporarily after the Fed for maybe a few days. But markets rarely bottom. Here's a daily. I don't think the 4 hour looks any better. No, it's divergence, but it's not ideal. It's above this low, but still under 30. So we could have a rally maybe back to 72, but I don't think that'll be the final low because of this. And what are you thinking going into the Fed? Are you flattening out, Blake, or are with different scenarios? Are you considering um, fading dollar weakness, going along with dollar strength? Where's your bias? Do you have any?
Well, first and foremost, I'm going to go back to what Ryan was saying, and you can look at whether you're looking at the euro or whatever. This is a really tight range, and this is like the last several months we're trying to base here in the euro. I think it's just been pretty strong. We broke out of this triangle. You can see that here's the triangle here.
Yeah,
Right, very easy to see, and you can see how we've just been, just been basically basing. Here, I can do it this way, I guess. right here, which is dollar weakness is basically just holding up, and then you have what's been holding us all week long is this range, right? So I've got some euro US dollar longs, and I'm probably going to just take them off at least for the meeting. I mean, it's basically a break even, it's slightly down right where it sits, but if up 15 pips from here, I'll be break even. It's basically a break even trade, and I'm waiting to take advantage of further dollar weakness, especially if we get a Fed that is more dovish. Now, I gotta, we're gonna go back and have this conversation with Ryan, because Ryan's, obviously upset because he keeps talking about it in our chat room about how upset a dovish or a hawkish cut will be. So
No, I'm over it. I'm over it.
no, you're not. You just 30 minutes ago, you were in the chat room going on and
I
on and
said
on. And
specifically,
somebody explained to me, when somebody starts a conversation with somebody explained to me this, that means they are severely irritated.
no,
So
show the conversation. I said, irrespective of the hawkish, unhawkish language, what is exactly is a hawkish cut? Because I keep hearing it.
can
But I don't
somebody
hear.
tell me, look, when you start a sentence with that, that means you are irritated. I'm
Read the next
sorry.
line. I'm not bashing on the language. I just want to know what it entails. No, I'm still waiting for an answer. What is a hawkish cut? What? Tell me. Tell me now,
Okay.
Ken.
All right. All right. Here's
They're expecting
where
2 cuts next year,
here's
according to
where
the
it's
docs.
hawkish. Here's
Yeah,
where it's hawkish. You got to cut, right?
yeah.
But you have more voters, more divisiveness, where you have maybe, and this is what Mark said in the chat room, just right here, no, not there.
What about
Mark,
Mirren? Yeah.
yeah, about Mirren. Let's just talk about that. So he was just saying, hey, if Mirren comes out and doesn't put in a cut of 50 basis points, but he was 50 last meeting, and he says 25, and then let's say we have Musa Lamb, let's say we have Collins and Schmidt, which was the outlier from last Fed meeting, that all voted for a cut, or excuse me, for us to hike rather, or let's say it's Schmidt and somebody else has joined Schmidt, but we still cut anyway. I mean, that's going to be a really big split, because you got 2 people voting for a hike. Let's say 2 people. I'm just throwing that out there. And you got a few people voting for a cut, and some that say we need to keep rates unchanged. That would be pretty hawkish, though. If somebody joined Schmidt and Mirren went from 50 basis points to 25.
No. See, this is where folks need to understand. Mirren only said he would vote for
You're the only one that
25.
doesn't understand.
I do. Mirren said he'd only vote for a 25 if he was splitting the vote by going for a 50, i.e. making it not able to pick a conclusion. That's when he said he would go with a consensus 25. That doesn't mean he wants a 25 over a 50. He means that rather than what happened with the Bank of England, where someone voted for a 50 and they had a split vote and they couldn't make a decision, they had to re-vote. That's why he's going for that. So all you're talking about, all about a hawkish cut, is how close we are to not cutting, okay? Not about whether they're going to hike or not. So firstly, it's, yes, language terms, it's less dovish, but that's not what a hawkish cut is going to look like as far as the market's concerned. We are, or as of the September docs, we were pricing between 1 and 2 cuts next year. If that changes, that's when it gets more hawkish or less dovish. If we're
Right, but what is going to cause that action, in your view?
Well, all these dissenters who may vote for a cut this time, but they move their dots for next year and make their statement for next year to say, okay, in September we were looking at, roughly 2 cuts in 2026. Anything less is going to look less dovish, potentially even hawkish, because if they say we see no cuts,
cut, you get a hawkish cut.
no, it's still undovish. It's still undovish. The shock would be if anyone votes and puts a dot in for a hike, that will be the shocker. If we see any dots appearing above what they set rates at this meeting, that's your hawkish shift, in my opinion. So that's the risk.
And jokes aside, guys, the
Yeah.
thing is it's really pricing, and it's what when the market looks at the pricing, whether you're looking at the CME page or you're looking over here at the Fed, you're looking at the Fed Watch tool, or you're looking over here. If you start to see interest rate probabilities shift from the Fed, that's going to be from two cuts in 2026 to maybe less than two or closer to one. That is where things get a little crazy, right, Ryan?
Yeah.
I mean,
This, I say every bank meeting, every important bank meeting, you have to know what the market is thinking going in. And the market going in, whether I agree with it or not, the language or whatever, as you say, the market is going in with a mindset that this is going to be a hawkish cut. Now, you'll remember back to the October meeting where everyone said, oh, it's all dovish. And I said, no, it's not. And remember what happened with the dollar? It dipped and then it rallied 400
yeah.
pips in dollar yen. So you need to know what the market is doing, because then when you get the details of the meeting, you can make that assessment. Is the market right? Is the market wrong? And by how much of a degree is it right or wrong? And if there's a big variation between what the market was expecting and what the Fed have delivered, there's your trade. Simple as that.
Dale says there's a non-negligible chance, 10% that they do a 50 basis point cut and done. Oh my God. I don't think that Powell would ever bite onto that. No one's going to bend a knee to Mirren. Sorry.
No one's doing a 50 without inflation.
No, yeah. I mean, we don't, and without the data to support it, can't do it. No freaking way. The Fed hasn't seen that's going back to what's going to happen after the Fed. I mean, we're getting CPI data, we're getting jobs data. The Fed's going to look like a bunch of dipshits if not like they've already lost credibility as it is. Want to make it even worse is they come out and don't leave the door open, come out too hawkish, where they don't leave the door open for a cut next month. And let's say the jobs data is complete garbage. Now, I know we're not seeing that now. We're not. I mean, we're even going to get the weekly Challenger job cuts here, which are useless, but we're going to get them anyway. But let's say the jobs data is upended and we lose, I don't know, 100,000 jobs or 150,000 jobs, and then the CPI comes in a little light, less hot. I mean, people are going to go, "Wow, the Fed is completely off base here." So I'm just saying, no, Dale, I understand what you're saying. I'm just saying I don't think it's even possible. I don't even know why people.
That's exactly what I said earlier this week and last week. This is the risk with this meeting. The Fed could be dovish, hawkish, whatever, and then next week we get all that jobs data, CPI, and everything else, and whatever, and it's all bad.
Right.
And then everyone goes, "Well, the Fed have just told us they're not going to cut again," and meanwhile we've just lost 200,000 jobs. So that's another reason why they're not going to pigeonhole themselves into a strong position one way or the other. Powell's going to stick in that middle line. We've got the optionality to cut again. We've got the optionality to stay on hold as the data defines. And that, I think, is going to disappoint the market with this hawkish slant that it's in.
Yeah. So, looking at the market, going back to Dale's original question, like, what am I going to do? I'm actually hunting for euro dollar longs. You got to assume that as we go into year end, there's going to be some dollar selling flows because stocks have been so damn strong. You know what I mean? You gotta assume that dollar selling is in the models right now for the end of year. So if we get a Fed that leaves the door open for I mean, Powell's going to say January is still on the table. He's got to. I mean, he's got to leave that door open, I would think. But if the rest of the dots are kind of pointed towards more than 50 basis points of cuts in 2026. You might get some dollar weakness, and I would be looking for the euro above 116.60. And if it's hawkish, then we're down below 116, and then things get a little things look a little bit better for the dollar. I mean, the dollar is, you look at like the euro, we're trying to break out of this triangle. We're trying to move to the upper end of this range, which, by the way, if we're in a rising channel, we could get all the way up to 120, on dollar weakness, if given that way. And look at equities. If equities continue to, if we get a dovish, oh, well, we got a couple things. We get a more dovish meeting. Let's just call it we get a cut and it's somewhat dovish. You have Oracle tomorrow. Oracle is like a big deal right now in AI. There's a lot of news surrounding Oracle right now, and their earnings are today after the close. So you got that to look forward to, and then we've got more data next week. So obviously we're setting the stage for some pretty good moves after today, and so I'm excited, but we just got to get through today first and see if the Fed will give us that, open the door for us, and that's where these flags come in. You look at Sterling. Sterling's kind of same way. We're still in this bullish development here. We're holding. I've had bids all week at 138 or 132.80 at night, like when I'm sleeping, and I've failed to get my orders triggered the last couple of days. But you can see how it's flagging, and it's got. If you're bullish the dollar right now, you're probably looking at some of these patterns going, man, what happens if the euro trades above 117? What happens if the sterling trades above 134? I mean, we could really see, we can really see some squeezing here. So I think if you're a dollar bull right now, you are probably playing a little bit of defense, would be my opinion.
Not that it matters. Don't forget we've got the BOC today as well.
Yeah, we do have the Bank of Canada, and we did complete that butterfly pattern. We'd been talking about that since last Friday. Once we broke through 130, 139.30, and we actually hit to the pip, and maybe overshot it by about 10 pips of that butterfly pattern. And while we're below this 139, which is 138.90, we have to remain bearish here too. But look at the Canadian. I mean, we're back at this trend line and just really respecting it. So a fresh move below this 618 retracement really opens up 137. I don't know how hawkish the Bank of Canada is going to be, but look, you look at the RBA, you look at the RBNZ. RBNZ is their next move is probably going to be a hike. The RBA's next move is probably going to be a hike. If the Bank of Canada signals the same, we're looking at a central bank regime that is looking at, and this is including the Fed, right? Where we have all these other central banks that are looking at hikes, and the Fed is still looking for another, quarter point, maybe half point cut in 2026. And that's the real divergence here, because if you get a Fed that remains pretty dovish today, and you have all these other central banks that look, even the ECB today, Ryan, wasn't the ECB talking about, rate hikes?
No, the ECB wasn't. The market was, because we have seen this global shift where the market's thinking that the next major rate move, or the next rate move for those who have got their rates down, is going to be up. And I think that's a risk that we need to look out for trading wise. I think it's a risk for the Bank of Canada today. They've just pretty much finished their cutting cycle, or got to the bottom of their cutting cycle. They will not want the market getting hawkish, because it's going to undo all the rate cuts that they've done, which is not what they want to do. They don't want to see inflation taking back off again, inflation expectations taking off again. Neither do the ECB, neither will the Fed. So I think the risk for the Bank of Canada, which could affect the wider market, is that they push back against this hawkish pricing we've seen in Canada swaps and the like, just to say, we're at neutral, and we're going to stay at neutral for a while. And we still may cut if the economy weakens. So don't even start talking about hikes. If they push back, that might have a wide implication for the broader market that's been getting more hawkish.
Right, and then that goes back to the Fed. So you got because you do have and AJ, you're right. They're not going to hike rates right now. We're talking about future pricing. This is what the RBA, the RBNZ, everybody's looking at these central banks saying, okay, their next moves are going to be hikes. And if the Bank of Canada tries to put that to bed, and so does the Fed, as well, and they come out a little bit more dovish. Again, this is a recipe, in my opinion, that just sets us up for the S&P to be trading at new all-time highs. I mean, dovish central banks, if they both remain dovish, next thing you know, we're probably trading at all-time highs into year end, and we got a Santa Claus rally on our hands. But everybody's thinking that way, like what Dale said a little bit earlier. So we also have to take that into account. Dale, is Joseph here?
He said he's going to be 15 minutes late. Do you want to wait for him?
Yeah, of course. Yeah.
Okay.
I mean, having Joseph here on a Fed day, I'm sure everybody that is listening in would love to have that. So let's talk about a few other things while we're here. Let's talk about what's happening in precious metals. I know, Dale, you already talked about it. Gold has been stationary. It's been holding up. I'm assuming that today is going to be the day where we can try to break free of this range. This is about 100-point range. You can see it right here. Silver is obviously just on fire. And Steve said it the best the other day. I can't remember if he said it on this show or if he said it on the Morning Edge, which is our show that we have in about 45 minutes from right now. But he's like, my biggest fear is we're not going to see below 50 again. And the risks are building that is the case. I mean, let's not forget that this move that you're seeing in silver is a massive breakout. And I'm on a weekly chart here, and you can see this is just a massive breakout where now any move towards $50, you're gonna have buyers. Any move towards $55, you're gonna have buyers. Everybody's gonna be trying to step in to buy this, because now on everybody's radar or what everybody's saying is, why can't we see 70? Why can't we see 100? And I think that is a bigger risk that is brewing at the moment. And then you have precious metals like palladium and platinum that need to, they look like they're trying to play a little bit of catch up. I know we joke, but I don't know about you, Ryan, but when you and your wife have been together as long as me and my wife, pretty much. Maybe a year or two difference. I bought my wife's platinum ring back in '99, and platinum was double the price of gold at that time, and gold has left platinum in the dust. So maybe there's
did you hedge the ring?
No. I hedged it with a blood diamond. How about that, Dale? Yeah. So, but realistically, you look at some of these other metals, and I was having a conversation with one of my buddies the other day about, because he loaded up on silver and gold like last year, and he's like, what next? And I'm like, I don't know. These precious metals look like meme coins now. You're gonna find different metals that maybe haven't mattered so much in the past that are going to probably play a little bit of catch up with the big brother and sister, silver and gold. So I look at some of these other metals as probably value plays at some point, whether it's today or next month. I think that people are going to be buying dips. Ryan, as we go into the Fed, what are your thoughts about the dollar as a whole? Just because the dollar, let's just pull up the dollar index, and I know you or most of us don't trade the dollar index per se, but what do you make of the dollar here?
It's interesting because despite all this, hawkish cut business, we're not seeing a big dollar reaction. We're not seeing a huge rally in the dollar.
Right.
All right, you can look at dollar yen. That got back up to 157, which held again. But yeah, so that we know the dollar's still on a weak footing. So even if we get this hawkish cut, is that going to see the dollar, turning around and being completely bullish into the end of the year, or is it just going to be a little bit of a rally and then the market comes in and hits it and we go even further down than we have done before? So that I think is the risk either way. I think I'm talking myself into looking at dollar shorts or getting short into over the Fed, just on the back of that thinking. Let it rally if it wants to rally, and maybe hit the rally and see what happens after.
Yeah, it's going to be really. I mean, I look at these yen pairs, and let's not forget. I mean, I sold my Canadian yen yesterday, but man, this thing's broken out. I think this is obviously more of a yen story at this point. People just don't believe. I think I showed you guys this yesterday. At least I showed our morning edge people this. If you look at interest rates for Japan here, right? You look at interest rates for Japan and you go all the way out to, here's where Japan's been beaten into submission with deflationary pressures for 30 some odd years, right? Just because we're going to be moving up in rates with the BOJ, it doesn't mean that, that rates are going to be moving, above 1 to 2% in the years ahead. I think the BOJ is going to be very timid, in making sure that messaging is not out there. But people look at this and say, well, Japan hasn't had rates. You're going to you'll see all the headlines next week if they're going to raise rates, and people are going to say, rates haven't been this high in Japan since 1994 or whatever. So highest rates in Japan in 30 years. But again, you look at the yen, and I think the yen is pretty telling right now, suggesting that they don't believe that the BOJ's got it in them to be too hawkish. Isn't that what it's telling you, Ryan?
It's telling me that the market's fully priced in the Bank of Japan, and that 25 pips isn't going to make much difference unless they indicate that they're going on a little hike spree. If it's a hike and then they're done for another 6 months, 8 months, or whatever, the market's going to look at it and go, right, well, we'll carry on selling yen. Thank you very much. And as I said yesterday, I think that will put us, if we're not there already, because the yen index, or the Yendex as I call it, is now below 75, 74.95. That's what the BOJ look at. We're going to have potential intervention after the BOJ.
Yeah, I mean, we're gonna be in the intervention window, I would assume, especially if the dollar yen starts trading up towards 160. So,
and I think that's even the case today. If we see a big move up in dollar yen, it's back at 158, going through 158. Then I think the door is wide open between now and the BOJ for them to intervene.
Yeah. Well, getting a dollar rally, as you've been pointing out, it's been really tough for the dollar overall. So the euro is just maintaining gains. We have the Aussie. I mean, look at the Aussie. I mean, this thing. I know we just had a hawkish RBA meeting, and that kind of gave us that bullish outside day yesterday in the charts. But look, if you're short Aussie dollars, I mean, this thing has gone straight up for 2 weeks. And if you're long dollars or short Aussie, you're staring, highs that we haven't seen since back here in a year. We could be at brand new yearly highs today in Aussie dollars if we have a slightly dovish, or what's perceived as a dovish Fed, after cutting, more of the pricing mechanism. But and you have the Kiwi that's come out of this descending wedge. We're stuck at the 38% retracement. I said 32% retracement, 38% retracement. So a break above here I mean, that opens some upside really quick. Again, this is 2 weeks of stunned shorts going, holy crap, that thing just rallied in my face pretty aggressively. So I don't know. I'm with you, Ryan. I think that the risk is starting to build. If we see some dollar weakness, it could really precipitate into something a little bit more aggressive. And this is one that I've kind of, since we're here, and Dale said, Joseph needed 15 minutes. This is something I've been talking about to the Forex Analytics subscribers on our show. Look at the US dollar Swedish krona. Look at this one. And look at this lack of ability for the US dollar Swedish krona to route. This is one I don't trade often, but when I do, I love trading it. And what I've been noticing here is the dollar, when you talk about the dollar being weak, think about how it is against like all these Scandies, between Norway, that hasn't really done a whole lot either. And you got Sweden. I mean, these look really, really strong. Do you trade the Swedish krona much, Ryan?
Not an awful lot. Now and again, depends on if it hits some decent levels. I keep an eye on it. But this one, it's looking weak, but it's still a bit sideways for the pretty much all year.
Yeah, we're below the 618 of where we've been.
Steve went to Sweden for his bachelor's party and almost didn't come back, he told me.
Who?
Steve.
Oh, Steve.
Volge.
Yeah.
Steve Volge.
Yeah.
He likes Sweden, in other words. So he probably watches the krona.
I think this is a really, really nice setup. One that just, we have not rallied. The 200 DMA is obvious resistance now. It's horizontal resistance. I mean, that'd be a pretty big move if we got back up here, to this level. But you can see this thing's just kind of bleeding lower. And if the dollar starts to weaken, I mean, I know everybody's looking at the euro, and everybody can go, oh, well, the euro can go back to 120. I say that too. But I mean, this thing could really take a spill. Also, since we've been talking about dollars, look at the rand. This thing is walking a tightrope right now. You want to talk about the rand? Same with the Mexican peso. I've been trading in and out of that thing, and I mean the dollar rand has some pretty big downside here if things want to open up. Dollar Mexican peso, hasn't mustered a rally. I keep thinking it's trying to base. I mean, I guess that you could say it's basing, but sure as hell ain't rallying. So if dollar weakness really comes in, you could see it pop up through a lot of different currencies, in my opinion. So
I don't care really much about the outcome, except that I'd like to see some movement and expanded ranges, and for Rip Van Winkle to wake up from his nap already, so we have some action to trade. So
yeah, me too. I mean, I agree. This is it has been. It gets a little scary around this period because we are going to have end of year flows, and we don't know what they look like. Have you read any indication, Ryan, about what end of year flows look like in the dollar?
Not as yet. It's probably a bit too early because we'll probably get them after we get through all these central bank meetings.
Yeah, because this is one of those situations where if the dollar takes off one direction or the other, whether it's a bullish move that we see in the dollar and we see the euro back below 116, or we see a dovish Fed and we get the euro back above 117. Regardless of what we get, things are going to start to thin out after next week, and that's where I can't tell you how many times I've seen the Aussie dollar move 200-300 pips in like 2 days at the very end of the year, just because of flows. And that could very much be the case. Where the reason why I mention all this is you have to be really careful about fading breakouts during this time of year, because if it's flow driven, there's not a lot to stop it, because everybody's going to get out of the way. So let's see if Joseph has made his way over here.
Not yet. I'll let you know.
Okay, all right.
Watching.
So yeah, it is going to be a really, really interesting day, I think, today. Uh, let's see, currencies. Oh, one thing I should talk about real quick while we're still waiting for Joseph. I do want to talk about crypto. This is if you okay. Let me just backtrack a little bit. Every day we do the bias chart with all of our traders. So in about 30 minutes from right now, we do the morning edge. The morning edge, we fill out these really key levels. And I think every day in the last week, we've written down 94,400, 94,500, whatever it is. And you can see we just keep knocking our head against that. That is previous support from back here. Now, if we can break through that today, because let's imagine it's the Fed's a little bit more dovish, the dollar gets hit. The next stop would be the 50 DMA, or what I think is bigger resistance, which could also be flag resistance, which is at 98,000 or so. So this is, you would hear me call it triple confluence, right? You have a flag resistance, you have previous support, you also have the 50 DMA right there. When you get triple confluence of something, the risk is that, we're going to get a reaction from there. Whether it's a big reaction or not, we're probably going to see some sort of reaction. So if you do see a rally in crypto after today, because the Fed's more accommodative, they're a little bit more dovish, I would just watch, for upside might be somewhat limited. And matter of fact, I believe, if I'm not mistaken, let me grab the tool. I think that's a 38% retracement, and it is. So you could say quadruple confluence right there. The 38% retracement is right at that spot as well. So if you guys are, trying to trade crypto, and just realize that, especially on a breakout today, which it could very easily break out above 94 and a half, upside might be somewhat limited. If it gets up there, Bitcoin is still really underperforming risk assets, the bottom line. So it really is just not looking great. Ryan, any last minute thoughts while Dale's looking for Mr. Wang?
Yeah, just for anyone who's trading over the FOMC later, just be safe. If you don't understand what's going on, if you're not sure what drops, what's said, what the votes are like, what the dots are like, sit back, plot your levels, trade levels that you think you might want to trade that are not close to the market. Obviously, stay tuned into the chat room because we'll have all the coverage there for you. And but if in doubt, stay out and pick up the pieces tomorrow.
Yeah, this is the Forex Analytics chat room is a great place to be on days like today. I'm actually going to be broadcasting on a different show through the FOMC, but I'll be in the chat room as well while broadcasting, because fortunately I'm not the only one that will be on the show. So, but the chat room is going to be where it's at. This is where we have, everybody's breaking down what the dot plots look like, how dovish or hawkish the meeting is, and you'll have a much better grasp of everything that we've got going on, in the Forex Analytics chat room. So looks like Joseph did make it.
He is here, yes.
Yes, Mr. Wang is in the house. So you guys are in for a real treat. It's great to have Joseph here on a day like today, especially with the Fed meeting, because I'm going to stick around. I want to listen to what Joseph has to say, because we want to. Ryan keeps saying that having a hawkish cut is not even possible. So we want to see what Joseph has to say about all this.
Okay. Well, thank you, Ryan, and we'll
Cheers,
carry
Craig.
on. Well, and thank you, Blake. We'll carry on this conversation. Welcome, Joseph. How are you, buddy?
Hey guys, thanks for inviting me. Apologies for being late, but glad a lot to talk about today. So let's get right
Yeah.
into it.
Okay. So cut done, and I don't think you're. Do you think there's going to be a hawkish cut? That's the narrative, the consensus. From your writings, I would think that you'd be looking for a dovish cut.
So I think I mean, we're going to have a cut and we're just going to have it meeting by meeting. So the market is pricing in more cuts next year. And today, what I think they'll do is they're just going to cut and then they're going to signal more data dependency, seeing what will happen. And I don't know if the market will react too much to that because, like you mentioned, that's the narrative. It's already in the price. The market is more concerned about weakening labor market data. And we did have a weak ADP data last week, and it looks like we could get more data next week with the NFP. So I think what the market is saying is that they're seeing additional weakness in the labor market, and so based on their understanding of the Fed's reaction function, we're going to get at least the two more cuts next year.
Okay, Joseph, we had a little breakdown here in the TLT. Uh, can the Fed save long end duration with the cuts that are coming, or is it going to be still more difficult for the bonds to rally because it's happening globally, so there's a global pressure, and people are worried about maybe the new Fed chair is going to be an easy money guy, and they want higher yields to buy long-term paper.
So I think you're making a very good point about what's happening globally. So bonds are a global asset, right?
Yeah,
Global institutional investors connect bond markets throughout the world. If they think yields are high here, they can go there. I mean, after on an FX hedge basis, and you do have bond yields rising globally, notably, of course, in Japan, where their
yeah,
central bank is still in hiking mode. But in other central banks, like the European Union, like in Canada, their central banks have kind of signaled that they're done cutting, or at least pausing for some time, and so that puts upward pressure on their yields, which in turn spills over to what we have here. So I think
you
for
you,
the
you
US,
wouldn't
though,
go, would you go that far out on the curve with what you see coming from the Fed, or do you stay, within 90-day paper to 2-year paper?
yeah, I
So
don't
you
want to
don't,
take too much interest rate risk since we have so
yeah,
many things going on. But
yeah,
what I will
okay,
push back against is the idea that, the Fed is going to cut rates. We'll have this dovish Fed guy come in, and the bond
okay,
market will melt down. I don't think that's how the world works. I mean,
okay,
you have this. I'll give you an example from the equity market context. You have an idea that, this company's equity prices should be related to what they're earning and so forth. But, that's just not true. I mean, you look at, let's say, Palantir or Tesla, there's no valuation justification for that, right? So what can become expensive can become even more expensive, absurdly expensive. So this mental framework that we have that we think makes sense is not always true. Now, in the bond context, you can say that, hey, we have 6% fiscal deficits, we have all these governments who want to spend even more money. Shouldn't the bond market be revolting? But no, it's not. And you can go to look at Japan and say, well, you got 250% debt to GDP, and yet the bond market doesn't seem to care. So our mental models of how markets work not always true. Now, so I'm not really sure if we would get if it were cuts, we would actually have some kind of revolt in the bond market. But at the end of the day, even if we do, Fed would just come in and stabilize it. So, I think rates going forward, there's going to be a heavy political component, and nobody is good at guessing that. So, unless you are, you're a liability-driven investor like a pension fund trying to hedge your future liabilities, I think it's just going to be a trading vehicle, and it's going to be hard to guess this stuff.
okay. Some people bringing up concern of next year of the unwind of the carry trade. It's not going to happen until it breaks down. Do you have a view on the potential of a carry trade unwind?
So I would make an observation that as bond yields in Japan have risen, the yen has actually continued to weaken.
Right,
So if you want the carry trade to unwind, you want to see a sudden strengthening of the yen because a lot
right.
of the people who are in this trade, their liabilities are in yen. So when the yen strengthens, that's
Right.
when they feel pain. You don't see that right now. What you do see actually is, honestly, it looks like a huge nominal growth boom. You have Japanese equities up, Japanese yields up, Japanese currency depreciating. That's just consistent with a nominal GDP boom. It doesn't seem like it's something that is a problem at the moment.
Yeah, at the
And
moment.
one other thing to note is that inflation in Japan is actually the same as the United States, 3%, but their 10-year yield is like below 2%. So
Yeah, so negative yields.
yields are too low there, and rather than say that they're rising and the yen is going to strengthen, I would say that they are um, still too low and just gradually trying to find a better equilibrium. So until you see the yen strengthening, I don't worry about the Japanese yen carry trade.
I think it's going to take intervention. I don't think the yield, their interest rate hike that they do on the 19th is going to be enough. And do you think that, Bessent isn't real happy about uh, Japanese, currency depreciation against the dollar? You think it's possible that the U.S. could cooperate with them with some kind of intervention when we get up towards that, 58? These are, prior intervention levels that we're approaching right up here.
They don't, so far, the administration hasn't seemed to be too keen on FX orientation, except in Argentina. So the strategy they've
Yeah.
taken has instead just going to Japan and telling them that, you have all these dollars that you made through trade. I want you to invest them in the United States and improve our economy that way, rather than saying that you have to strengthen your currency so that you can buy more U.S. goods. So they haven't taken the currency route so far.
Yeah.
So I don't know if
Okay.
they plan on changing that, but I think currency, if the yen is too weak, the Japanese authorities can intervene on their own without coordination.
Okay. All right. So let's talk risks now. I don't know, about a month or so, you were talking about AI being in a bubble, but you never know how big a bubble could expand to. And lately, it sounds like you're pretty bullish that because of Fed, because of liquidity that's going to be coming into the market. So, are you looking for another good year in risk because of that in 26?
So I think that, yeah, so I think that policy is shifting towards easing. We're going to have a more politicized, well, a Fed that's more under executive control. And I think the administration is gradually walking back some of its tariffs and things like that because it knows that it's not popular and they have midterm elections coming up. So I think for the first half of the year, I think it'd be positive for equities. But I think there's a very good chance that the administration will lose Congress in the midterms. It's not that it's just, history, right? For over
Yeah.
the past several decades, almost every time the president's party loses control of Congress in the midterm elections. So that's a very high probability thing. When that happens, though, you're going to have endless investigations. The administration is going to lose a lot of its power to stimulate. Maybe they'll even start having more oversight over the Fed. So at that point, it's more difficult to add gas onto this equity freight train. So I think heading into the second half, maybe that's when I think we'll have more hiccups.
Okay.
But
The
I
risk
think throughout the
aversion.
year,
Yeah.
yeah,
So
throughout the
that's really
year.
lousy timing for President Trump for the bull market to continue in the first half of the year and then start giving it up into the election. That would kind of seal probably Democrats gaining seats.
Oh yeah, but they're doing things like redistricting and so forth, right?
Yeah,
It's a creative bunch. They're thinking of ways, and
yeah.
so I wouldn't count them out just yet.
Can you think of anyone besides Erdogan, even in history, where an executive, a president, a prime minister um, has had great influence over the Fed and have it be successful?
So historically, executive control monetary policy is the norm, right? In the UK and France, for example, you did not have independent monetary policy until the 1990s. Today,
Okay.
looking across, in China, you don't have independent monetary policy. He does whatever Uncle Xi tells him to do.
Okay.
So, and they're doing fine. So
All right.
there are different ways to get accountable monetary policy. It doesn't have to be through independence. It can be, for example, through voting, right? President Biden's term coincided with tremendous amounts of inflation that was very unpopular and that hurt Vice President Harris's campaign a lot.
Yeah.
And so
Yeah.
people were upset and they voted them out. So this independent central bank thing is historically not necessary to have inflation under control, and it's kind of really clear in history and even today.
So, have you sold any of your silver?
Yeah, I sold all my silver, and then it went up 5%, so I'm sad.
You're great, Joseph. So, most important thing to look for in the statement today, presser.
I just want to see if we have asset purchases starting up again.
Okay.
I think everything else is in the market. I don't think that's in the market. So let's see whether that
Yeah.
happens or not.
And do you have a dollar view?
So I think the next decade is going to be a decade. Oh, sorry, next 5 years is going to be 5 years of a weaker dollar. One part of it is because we've got a lot of political changes in the U.S.
Yeah.
The foreigners don't care about this at the moment. They still love U.S. assets, but
Okay.
I have to. I think that's strange because we are doing uh, a lot of changes in the U.S. and so I think that should eventually concern foreign investors. So big fiscal deficit, maybe easier rates. That's all dollar negative. So I think that's the
Yeah.
5 year view. But I also have to note that other countries not doing that great either. So
Yeah.
that's what makes it a bit harder to call. I mean, let's say the Euroland, you don't have any growth, you don't have any technology, you don't really have you know the outlook isn't that great. So it's kind of like everyone is not doing very well. I think so.
Yeah.
It's not super clear to me.
I remember last year, you were talking about that, people, it seemed like they wanted the war in Ukraine to continue, that there were forces that wanted it to continue, and it does continue to this day. Do you see Europe getting involved? Do you think about some of these geopolitical things when you're looking at the market? Anything that you're paying attention to that gives you pause about risk in markets?
So I like gold a lot. I think of gold as being long chaos. So we
Okay.
have a lot of geopolitical changes in the world. Like we just had that super interesting national security document from the US. It's
Yeah,
it's a huge 180 degree from how things used to be. They're talking
right. It
about,
is.
they're talking about, maybe trying to interfere into Europe because they don't like what's happening over there. So these are big, big changes. And when you have big, big changes, you have uncertainty, you have fear. And so I think that's good for gold.
Okay, Joseph. I want to thank you so much. Good luck today. Good trading, and appreciate you coming in through the years and giving us clarity because you were there and you know, uh, great points about people fearing what's going to happen with the new Fed chair. That it's not going to just turn into an Arthur Burns right away.
Not right away.
All right, buddy. Good
All right,
laughing with
guys.
you.
Happy trading. Talk to you
Yeah,
guys next
everyone
time.
follow Joseph and take his course to learn about central banking. So you did change your handle on X. It's now Joseph Wang,
Yep,
not
Joseph Webb.
not Fed Guy 12. So you could find Joseph on X and then go to his website, and you could also get some free updates from him. And maybe you have an affinity to really want to understand the plumbing of what drives the financial system. I don't think you could find a better mentor than Joseph for that. So that's a wrap. Thanks again, Joseph. And everybody, remember, don't just count your cuts, count your blessings. See everyone tomorrow, and you could join the team on the morning edge in about 10 minutes. Adios. Thanks again, buddy. You're welcome. See you, Saloom. See you, David.